Welcome back. Today I'm sitting down with Anmol Grewal. Anmol is an insurance expert in Lake Tahoe. And today we're going to talk about why insurance is so difficult to get in Tahoe, what you can do as a buyer to navigate the insurance process to make sure you get insurance with good coverages at a fair price. And we're going to answer some high level questions as to what is the California Fair Plan? Is it the only option? Why is it the only option? Can you get insurance on every home in Lake Tahoe? Are extra policies needed? What do they cover? We're going to talk about why it's important to start the insurance process early. So everything you need to know as a buyer, we're going to talk about that today. Anmol, thank you so much for joining me today. For people that don't know who you are, do you mind giving yourself a brief intro of who you are and what you do?
Absolutely. Thank you, Shay. I appreciate you having me. So my name is Anmol Grewal. I am a independent insurance broker. I'm with Goosehead Insurance, and I've been in the business for about 10 plus years. Currently, I focus more so on high wildfire risks, so places like Lake Tahoe. And so the majority of my business is currently focused there. Um,
Excellent. And I know you're a broker. How does being a broker benefit buyers and people needing insurance?
Yeah, so that's a good question. So there are multiple markets in California, and I think most of most people will kind of gravitate towards the companies that they see commercials about or just have maybe heard about from word of mouth. But there are hundreds of companies out there, and so brokers have access to multiple markets. We can shop different markets, different companies. To try and find a good fit depending on what the specific property calls for. So the standard market, a lot of the insurance companies that people know about, like State Farm, Farmers, these guys, they're looking for different types of things, and there are non-admitted specialty carriers that are looking for different types of homes, and so not every home is going to be a good fit. And so doing the due diligence and being able to shop around different markets, different companies, it benefits the buyer and just having a lot more options in the carrier.
So let's get right into it. From a buyer's perspective, and this is for buyers, why is it so difficult to get insurance in Tahoe?
So Lake Tahoe really is kind of the perfect storm in terms of risk exposure for insurance companies. So I'd say one of the best pieces of advice I like to give my clients is that insurance companies are businesses. They are in it to make a profit. And, it's best to view them that way. And so a lot of times people get really, I guess, committed to a single company. And if they're not shopping around, it can really cost them a lot of money in the long run. And so in Lake Tahoe, the exposures that insurance companies see are just totally different because in a lot of parts of California, the companies or locations may see one particular exposure or maybe two exposures. Lake Tahoe's pretty much got it all. So you've got wildfire exposure, you've got dense trees, you've got mountainous terrain. There's limited access to a lot of properties. There's snow, which will bring weight of snow claims. And so, that factored in with the high rebuild costs, that really is what drives the price up in insuring homes here and makes it a little bit more difficult to find carriers that are willing to accept the risk. And so that's why specialty carriers often are a really good alternative to the California Fair Plan, which is the carrier of last resort. And so I think a lot of people in the Lake Tahoe area are probably familiar with Fair Plan or just the idea of it. But they may not know about the, other insurance markets that are available to be able to assist them in these types of situations. And so carriers will evaluate, the surrounding communities, not just a condition of the individual home. And so, sometimes they may stop writing business in a particular area and then pick it back up later. So companies will reach capacity issues. And so there are a lot of moving pieces in Lake Tahoe, which it kind of is what's causing the difficulty for a lot of people.
Can buyers expect to have a difficult time getting insurance when they're buying a home in Lake Tahoe? Should that be the baseline expectation?
So I wouldn't necessarily say it's it's difficult. You just want to be educated on the process and the options that are available to you. So I have not come across any properties that I was unable to insure. It really just depends on the price tag of the policy, because the rebuild cost of the house is going to matter, the location is going to matter, and so doing due diligence early, getting an early start, I'd say typically at least 20 to 30 days out of escrow, is going to give clients the best opportunity to find the best fit. And so, sometimes I'll come across people who are like, hey, I just got into escrow. We're closing in 2 weeks. I haven't looked into insurance. And so that is really when, it can hurt you. So taking that first step and doing the due diligence on the front end is really what's going to help people.
Those are great points. Let's talk about why insurance is different from home to home. I've seen instances where homes right next door to each other have different abilities to get covered. One can't get coverage at a specific carrier and one can. Why is that?
So timing is really going to matter. So I kind of had touched on capacity issues. So basically what that means is every insurance company is going to have a certain dollar figure that they're going to want to insure up to for, let's say, a zip code. And so let's say if that dollar figure is, I don't know, 100 million, I'm just throwing a number out there for a particular zip code. Once they hit that number, they're going to shut down new business. And so over time, let's say if policies fall off or they feel like their exposure is little bit more limited than before, they may open up or reopen that area. But let's say if your neighbor got a policy with that particular company, it's unfortunately not going to be, available to you. I've had clients where someone purchased a house 1 month, and 1 month later, someone else purchased another house down the street, and the company that the first person got was no longer available to the second person. So we just kind of have to move on. Taking that out of the equation, you've got individual property characteristics. So you've got the age of roofs, a defensible space between the house and maybe trees or combustible sheds, things like that. It could be occupancy type, claims history, prior insurance. So there are a lot of different factors that could play into that. Occupancy is going to be a big thing in Lake Tahoe because not every home is a primary home. It could be a secondary home. It could be an Airbnb, and so carriers are going to be turned off depending on what the occupancy is. So if it's a short-term rental, then that's going to knock out a lot of insurance companies from the carrier pool. So if your neighbor is using the house for a primary residence or maybe even like a long-term rental, that's going to be very different from a short-term rental. So if someone's just using it as a seasonal and then short-term rental in the meantime, that is going to basically require a completely different carrier pool than the home that's next door. So there are a number of different factors that they look into, but yeah, that's definitely a frustrating thing that I've run into a number of times.
Let's talk about the occupancy a little bit more. Is it more risk? Is that why? Because what I've seen in my experience is, yes, there's been clients that have purchased homes as a certain occupancy, and then later down the road, they decide they want to do something different with the occupancy, but the insurance changes drastically. Why is that?
So that could depend on ownership. So I just had one recently where a client purchased a house and then later converted it to an LLC. And simply because it was in an LLC, it's no longer looked at as like a personal, residence. It's looked at as a commercial property. And so now, instead of having a personal lines policy for the dwelling, they now have a commercial lines policy. And so naturally the cost is going to increase. And so I'm guessing it was something like 3,000 he was paying initially, 3 to 4,000. And then I quoted him for a commercial, jumped to 12,000. And then after all the underwriting, they bumped it back down to 6,000. So it ended up doubling what he was paying before. I mean, it was a lot better than the 12,000 that we had initially looked at. But that kind of goes to show that nothing is really set until the insurance company completes all their underwriting. And that's why it's really important to get an early start, because you may get a quote from a company and it may say X, amount of money for the annual premium. And then when you go to close, underwriting does their thing, and then boom, it's 2 times what it was before. And so, I know you guys have been really great about that for all the clients that you send my way. Is you give me plenty of time to be able to do the due diligence. And so That's a really big thing.
So getting started early is very important.
Mhm.
Understanding that occupancy matters to the cost. So is it true that a primary residence is going to be cheaper than a second home or investment property? And is that just based on risk purely?
Correct. Yeah. So when you're thinking about insurance companies, everything is in terms of risk. And so, if a primary or if a client is using a home as their primary residence, the insurance company feels that that person is going to be there every day. They're going to take, pride of ownership. They'll be taking care of the home, maintaining it. They're going to do everything that they can to limit liability exposure for the insurance company. If it's a tenant, they unfortunately people have the idea, they're like, oh well, this person has insurance, I'm not worried about it, so they're not necessarily going to go to the lengths that the owner is going to go to take care of the property, and so the insurance company knows that. And then when you go down to short-term rental, it's even less responsibility that that person is going to take for the house, right? So as the risk increases, so will typically the premium and the difficulty in placing that risk. Again, so that's where the having multiple options really becomes really important.
That makes complete sense. So let's talk about the California Fair Plan here. What is the California Fair Plan?
So the California Fair Plan is not really an insurance company. Essentially, it is a insurance pool. So California Fair Plan acts as a carrier of last resort. So they do not want to be insuring homes any more than we want them to be insuring our homes. Really, the only reason why they're there is that they offer coverage to people who can't find coverage anywhere else. Now, that may be because the standard market is completely declining them. It could be because the non-standard market is just incredibly expensive. I mean, there are some policies that will come back 30, 40, $50,000 a year. And so that may not be, realistic. And so California Fair Plan is basically the alternative, the only other alternative. If you have a loan on the property, you're going to have coverage for fire. So that's why the fair plan is necessary if you can't find coverage through anyone else. But essentially, it's just a insurance pool. So the fair plan will financially back the standard market, and then the standard market financially backs the fair plan. So those two essentially rely on one another. So to give you kind of an example, the fires that happened down in the Palisades, when California Fair Plan runs out of money, they basically tax all of the standard market carriers that are on the approved list for the California Department of Insurance to pay their fair share. So, like, let's say if Company X has 10% of the market in California, after Fair Plan runs out of money, they will then tax that insurance company 10% of whatever the balance is left over, and that's how they take care of all of their losses. And so that's why also a lot of people will see price increases for things that they not necessarily have filed claims for, right? So if you are with, let's say, I don't want to say a name, but let's just say Company X has a bunch of houses insured in the Palisades. The Palisades loses a lot of money through a fire. I don't live in the Palisades. I live, let's say, up in Sacramento. My insurance company is still going to raise my rates because my insurance company had to pitch in to pay for those
They're
claims.
recouping their cost.
Correct. And so these two, rely on one another to prop each other up. The non-standard market does not have to do that. So if I have a policy through the non-standard market, Fair Plan loses money. Fair Plan can't tax my company because we're not, within the admitted system.
And what's the
so
difference between the standard and non-standard market?
So both are going to have pros and cons. Some of the big ones, or I guess the more prominent ones, is the state is not going to financially back the non-standard companies. The non-standard companies have different flexibility in terms of the types of coverages that they can offer, the type of risks that they can accept. The pricing is going to be a little bit different. The non-standard market is going to be more dynamic. And so if a particular insurance company feels like they're undercharging for a certain area, they can just bump the rates up. whereas the standard market has to have it approved by the California Department of Insurance before they can do that. And so those are probably the two biggest things. Typically, when I work with non-standard companies with clients, I send them a ton of information, links, and knowledge articles to kind of help them feel comfortable about the non-standard market. I myself have a non-standard company for my house. So it's not necessarily a bad thing. You just want to make sure that it's a financially strong company, because there are some companies out there that you don't necessarily want to do business with. But there are plenty of non-standard companies that are A plus rated through AM Best. They have great reputation. So it just kind of depends on the individual location. But the California Fair Plan wants to be the very last resort. So if you can't find a policy through the standard market, if the non-standard market yields a policy that is just not really doable, then you can turn to the Fair Plan, which is essentially your last resort.
Okay. The fair plan is the last resort. We see quite a bit of the fair plan in Lake Tahoe, especially when people need loans. You said it covers fire. Is that wildfire or is that regular fire?
Any fire, yeah. So it'd be any type of fire. So any type of fire damage is going to be going through the California Fair Plan policy. And so you had mentioned the secondary policy. So essentially what these two policies do is they work together to function as one. So let's say if a particular house was in South Lake Tahoe, you pick that house up, put it in the middle of Sacramento. You can find one insurance company that's going to cover it for everything that you need to be covered for under a standard insurance policy. The rebuild cost of that house, let's say if it's 1.5 million in Tahoe, it's probably going to be like $700,000-800,000 in Sacramento. And so the location of the house plays a really big factor in the rebuild cost of it. Of course, age, materials, all that other stuff does as well. And so, gosh,
is the extra policy really needed?
Yeah. So the policy is needed because it's going to cover you for things like liability, water, plumbing, weight of snow, which is huge in South Lake Tahoe or Lake Tahoe. And so really what it does is it rounds out the entire policy, because if you do not have the fair plan, they will typically ask you for proof that you have a supplemental policy. And so those two do work together. You want to have both. You could go, I don't recommend it. You could go do like a liability only policy, and that's like really, really bare bones. So essentially, if there's a fire, you're covered for the fire. If there's a liability claim, you're covered for the liability claim up to the limit. However, water, plumbing, all that other stuff, weight of snow, that's not going to be covered. So if it is a, really, harsh winter and you've got a lot of, snow on the roof and your roof caves in, you're not going to have any coverage if you don't have that secondary policy.
Important to have all the coverages necessary for the given location. I know, going back to Tahoe Insurance, so you shared a graph earlier before we got on the recording here. Do you mind pulling that up and showing people what and how the fair plan thinks through the exposure of risk?
Absolutely. So with the California Fair Plan, there are about 9 zip codes out of more than 1,700 in California that account for about 7% of the Fair Plan's liability exposure. So that comes out to
70.
7%.
Okay.
And so out of 1,700, these 9 zip codes are just shy of 10% of the total exposure for Fair Plan. So this is going to come out to roughly $44 billion just through 9 zip codes. Now, since 2022, it's been a 135% increase in monetary exposure just between these neighborhoods. And this information I pulled from Bloomberg just recently. So a single affluent Lake Tahoe zip code, where about half of the dwellings are second homes now, will make up about $9 billion of risk. So one fire, boom, $9 billion. And so that's why they look, at these areas with such, detail. And so the graph that I was going to share here, let me throw that up.
It is interesting. The more fires we have in the Tahoe area too, obviously the more exposure there seems to be and the more top of mind it is for companies, it seems.
Yeah.
So it's
Hmm.
been nice, knock on wood. We haven't had major fires in or around the basin since really the Caldor fire back in 2021.
Hmm.
Again, knock on wood. I hope it stays that way. But okay, excellent. So yeah, tell us about this graph. What's going on here?
Yeah, so these are the zip codes with the highest fair plan liability. So they've found that the risk exposure has grown the most in wealthy communities. And so, Lake Tahoe is up there. So we've got all these communities that are making up, I think it was this, 10 billion. It's got to be more than that. Yeah. Oh, yeah. No, it's
I
it's
guess
more
all
than
of
that.
them combined
That's
would
the
be,
total. Correct.
yeah,
So, I
would
mean,
be
it doesn't have the figure on here.
45,
Uh,
50 billion. It looks like
yeah.
if there's nine of them times, let's say, average five.
Hmm. Yeah. So, yeah, around 40. I think that's the figure that I had initially said too. So around 45 billion is where I would put it. And so, I work most of these areas. Like I said, the high wildfire is kind of typically what I focus on. And so do a lot of stuff in Sonora, Nevada City, Placerville, South Lake Tahoe, uh, Lake Arrowhead. These areas, you've got the Bay Area over here, down south here. This is just north of Tahoe. You've got Truckee, another down south. So most of it is focused either down south, Tahoe, or parts of the Bay Area. That's where these major risk exposures are coming.
Why is Truckee so far and above everybody else?
I think the rebuild cost of those homes tends to be higher. So you've got, a $2-3 million houses per lot. And so if you think about even South Lake Tahoe, any areas, let's say on average, 1.5 to $2 million rebuild, each lot that's boom 1.5 to each time. And so that adds up really quickly. And so a lot of, I would say the larger properties I've written that have, more acreage, and more square footage, those homes I found there are a lot more of them in Truckee. Um, and so the rebuild value of these homes is going to be higher, which is why the risk exposure is going to be higher as well.
That makes sense. I did a previous episode with a gentleman who's a builder in the area and just talked about the building cost in Truckee
Mm-hmm.
versus other places. And just due to the lack of supply of laborers, that there's such a high demand and such a lack of supply, the laborers demand such a higher pay rate than, let's say, in a Sacramento area because of that. And so just that to start is what drives up costs. And then there's other things too, such as regulations and building codes and all that. But
Yeah.
um,
I mean,
okay,
the rebuild cost is a huge thing in Lake Tahoe. That's going to change drastically depending on who you talk to. You may hear $500 a square foot from someone. You may hear $1,000 a square foot from someone else. And so it really just depends. And the California Fair Plan is only going to give you so much money to play with. Each policy has a cap of $3 million of total insured value. So if you add up all of the coverages on the policy, it cannot exceed 3 million. So you've got a house that is 2.5 million by itself. So you're going to have to allocate the majority of that coverage towards the structure, right? So now you're faced with a decision of, do I put all of the coverage towards the structure and just self-insure the contents inside? Do I leave a little bit for contents and, maybe play with it and move it around? So that's kind of the challenge that people are having to work with. Um, and so, yeah, that's definitely a factor that people have to think about.
interesting. Okay. And then let's talk about this from a buyer's perspective. I'm a buyer. I want to buy a home in South Lake Tahoe or Truckee or anywhere around the basin. What do I need to do? What needs to be top of mind for me? First of all, from what you said earlier, you need to get going on getting an insurance quote as early as possible if you have a specific property in mind. Now, I know that's work being done before you might be in contract, but why does that need to happen? And then what else do buyers need to be aware of during this process?
So the capacity issue does pop up from time to time, and so the difference in conditions carriers, the supplemental policies, they'll sometimes close down business, and so there are some. The closer it gets to winter, they'll stop taking applications because they know that's when the weight of snow claims are going to start coming in. sometimes and insurance companies grow privy to the things that people do to try and save money. People will maybe start a policy at the beginning of winter, and then when winter is over, they'll cancel it. And so the insurance companies don't want to people to be doing that type of stuff. They want to insure the risk year round so that they're collecting the proper amount of premium. So let's say if you either shop too far ahead of the 30-day mark or too close to the 30-day mark, there can be a lot of surprises that pop up. It could be increased cost. It could be the insurance company is no longer writing policies. So 30 days typically kind of seems to be the sweet spot. And
So
so
you're saying get a policy within 30 days of closing.
I would say at least start the shopping, get the policy as soon as you can, as soon as you're comfortable with the options that you've shopped. And so let's say, you start 30 days out, 3 or 4 days in, you're looking at policies, you find one you like, take the move and do it, right? As long as you feel like you've done the proper due diligence, because that policy may not be there next month. That company, not the fair plan. The fair plan is going to be there. However, let's say if fair plan has a rate increase that starts next month, then now you're going to have to pay the new price, right? And so that's why it's important to kind of anticipate when the close of escrow date is going to be. Typically, whenever I get a lead from someone, I'll ask them, "Hey, when are you looking to close?" And the only reason I do that is because I want to try and get them the most accurate snapshot of what that is going to look like when the deal is going to close. So doing your due diligence early, who you work with matters. Having options matters. Those I think would be the most important things. Once you find a property, try and find out as much about the house, as possible, as far as the age of the roof, other home systems like plumbing, electrical, HVAC. Those are pretty big. So roofs are a big pain point in Lake Tahoe. I think a lot of the wood shake roofs have slowly been phased out, but they're still out there. Some companies won't want those. If it's a composition shingle roof, most companies are going to want those replaced within 20 to 25 years, and that will vary from company to company. California Fair Plan, if it's a shingle roof, typically what they'll do, if it exceeds 25 years, they'll switch the coverage from replacement cost to actual cash value. So if there's a loss, they're not going to pay you what it costs to replace it. They'll pay you what it was valued at the time of loss. And so they really want these things to be updated. HVAC, usually they want within 30 years. Electrical and plumbing kind of varies. If you have a electrical panel that's outdated, let's say a Zinsco, Challenger, Stablock, these brands, insurance companies will typically want you to swap those out because sometimes they're looked at as like a fire hazard. And so you want to do this due diligence so you have that information available when you begin shopping, because I will ask those questions. And so insurance companies, they're going to want to know all this stuff. If if they're given incorrect information, they're always going to do an inspection. And so they'll come by, they'll take a look, and if they see that, let's say, hey, this electrical panel has not been replaced, it's one of the ones that works off fuses. They may say, hey, you're going to need to swap that out, or otherwise we're going to cancel or implement some other, coverage restriction or something like coverage limitation, something like that. And so the insurance companies are going to do their due diligence, but it's typically not until after the policy has been set up. And so the more information you have about the property, typically, the better I can help, because if the panel has not been replaced, that doesn't necessarily mean that you can't find insurance. You just want to find the right company that will offer you coverage with that type of panel. And then that'll buy you some time if you're wanting to, maybe, you're just moving into the house, you're getting used to the bills and things like that. Maybe a year or two, you feel a little bit more comfortable and you're saying, okay, you know what, now I want to start working on the house. I want to swap out the panel, maybe redo the plumbing, things like that. The more information I have at the beginning, the better I can help the client and kind of helping them map out what owning this particular property is going to look like, not necessarily just today when you purchase it, but in the future. Because just because an insurance company is insuring someone today, that doesn't necessarily mean that they're going to do that the next year or the following year. So my whole thing is helping the clients, stay in a good position in the future, not just getting them set up and then just letting them go after that.
That's excellent. Amal, thank you so much for the info here. Anmol Grewal with Goosehead Insurance. He is a broker. If people want to reach out to you, where can they find you?
Text and email is typically the best way to get in touch with me. That way I have everything in an inbox. I don't know if you are, I'm getting so many spam calls. So it's tough to, answer every phone call that comes up. So email and text is going to be the best way, the fastest way to get in touch with me. I am very, very responsive. People are actually usually pretty shocked how quickly I get back to them. And then if we ever need to set up a phone call, that makes it that much easier to just be able to schedule, right? So I work with a lot of clients. It's difficult to answer the phone randomly when it comes up. But if you shoot me a text and say, hey, Amal, are you free in 15 minutes? I'll shoot a text right back, yes or no, maybe, 30 minutes after that. And so I can coordinate that way and make sure that, I'm being respectful of everyone's schedule and so forth.
Absolutely. And I'll include your text number and email in the description below. And I will attest to that. Amal is extremely responsive, extremely knowledgeable, and takes great care of people. Amal, thank you so much. Is there anything you want to wrap up with here?
No, I appreciate you, Shay. I appreciate you having me on here, all the support that you've provided. You've been awesome to work with, and, working with teams, it really helps buyers. It sets us apart, I feel like, from other experiences, right? So like if you have to go and do everything yourself, it just makes everything so much more challenging. So working with people like yourself, other agents in the area that I've met, it's been awesome. So it's really a seamless process. I really enjoy it.
I agree. When you have the right team in place, things move smoothly. Things move very competitively priced, and also just things close on time, which is the name of the game. So Amal, thank you so much. And if you're still listening at this point, thank you so much for listening. Reach out to Amal if you have any insurance needs. I'll include his contact info in the description below. We'll see you on the next one.